And we are back at it. If you couldn't get enough of Dan Gjeldum in the last episode, we've brought him back because there are just so many things that we are unpacking here. Dan, I think everyone by now knows you need no introduction. You are the source of all sources when it comes to the mortgage world. Thank you for being here.
Thank you so much for having me again.
It's always a pleasure. I know we got a lot to deal with today, a lot to get through. Let's dive right in. You and I know there's a lot to be learned about online lending because it appears to have so many great advantages and can appear to be a really, really great option. But as I tend to inform my clients, there's a lot of things to consider. So I'd love to hear your take on the world of online lending. What is it exactly? How do you see it working? What do you think the challenges are?
First of all, I have a website, so I'm online, right? And as a company, we have a massive online presence.
Yes.
But it's all with whom you work, right? So one of the things that we have the ability to do when someone comes in is I can look up production from a loan officer,
sure,
right? Anywhere in the country. I can see how much business they do, tells me the experience of the person that I'm competing with. But number two on that is I can see where they close loans at. And so many people will come in with the Rockets of the world or companies like that. And they're buying in Chicago and they're buying a condo in Chicago. I can see that they've never closed a loan in the state of Illinois and they've never closed a condo loan.
Yes.
So yeah, they have people to support them, but it's different. It's not the same. Right. And you have people that are trying to educate people and they don't know what HOA fees are. They don't know what insurance costs. So we see that all the time when we're competing against them.
Yeah.
And we can kill the competition very quickly just by spending the time talking to them. Because I know if I spend 10 minutes with them, that's 9 minutes more than they spent with the online lender who kicked out a pre-approval letter.
Yeah, no, I think it's absolutely true. And the reality is, and you and I have had this discussion many, many times. So with the online lenders, and I think there's probably two portions of this. The online lenders that we're talking about are the ones that are literally working simply off of an online platform.
Yes.
Behind the screen. You're never going to see them. You're never going to meet them. You may not even talk to them much on the phone from that perspective. They are typically national. Some of them are even international, but they are not focused on a certain area. I'd also put in here, as you're just kind of hitting this note as well, some of our out of town people that don't do business in Chicago. Chicago has its own way of doing business, just like every other city, state, county, whatever. And especially then, as you alluded to, we sell a lot of condos. There's a lot of layers of complexity in our financing. Condo financing is way more difficult than a single family home or a multi-unit or anything of the sort from that perspective. So all the time we have people coming in that are promising the sky, the moon, the stars, and then failing to deliver.
Yeah.
Now, you and I had an experience recently that a client who very much appreciated you, very much thought you were an asset, said, gosh, I'd like to work with Dan, but I'm getting pressure from my family to work with our family financial planners team. And it was horrific. We had so many issues, so many misconceptions. At one point, I asked Dan to look up this lender. The lender had never done a condo in Chicago. The lender had only done 2 deals in the entire state of Illinois. It was disastrous. And you know what? It was one of those things that I understand that you want to use people that you feel like are going to have obligations. But a lot of times I'll tell my own clients, ask that lender how much business they've done in Chicago. Ask them how many condos. Ask them. And it's not, as I always say, yes, I like my team on stuff because it gives me confidence, right?
And you mentioned in that specific deal, you said, hey, this is what the bank is having an issue with. And I said, well, that's not something to have an issue with.
It was a lie.
Yeah, it was a flat out.
It was a total made up misconception
Yes.
to cover their you-know-whats.
Yes, they thought they maybe could throw in some fancy language and make it sound great. And I
We
panicked.
closed it, by the way, but it was horrific.
Yes.
The buyer knew it was horrific, and
It made me second guess myself. I was like, wait a second, what did I miss? So I went and looked. I said, there's nothing wrong with what that particular credit side thing was.
No, and I think the hardest thing that I always have as an agent, right? I go online, I see it. The Rockets, the Quickens, all of those places. If you look, they have these impeccable reviews, these great rates that they're focusing on. But I can tell you, as an agent that has done a lot of business in Chicago over a lot of years, decades, that 9 times out of 10, if we're having problems on the financing level, because we do so much due diligence before we even get into a contract, if we're having trouble on the financing level, it's 9 times out of 10 because of an online lender or an out-of-state lender. I can say that with utmost confidence.
Yeah, and as someone who is a national lender, I do deals in New York. That's worse than here in terms of how things work.
Oh, I'm sure.
I've learned over time how they work.
Yeah.
But it's there's ways to do it too, right? If I'm doing a deal out of state, I would call you as the listing agent and say, hi, Amanda, I'm from Illinois. I know I'm not local to you. However, this is my experience. This is how many deals I close. All of that to put you at ease, right? Certain. But that doesn't happen with the online lenders because more often than not,
you can't get anyone on the phone.
You can't get a hold of anybody. And if you have to dial an 800 or an 888 number,
you're done.
To reach a lender, you're done.
That's just it right off the bat.
100%.
You are done.
You're done.
Okay, so obviously we're getting to be very experienced in competitive situations. And as I always try to, I lean in on my lender as much as possible. I know you really like my 10 p.m. calls. How are you seeing agents and their clients utilize the financing in competitive situations? How are we getting in front of the pack with our financing?
Yeah, I don't know why everybody doesn't do this stuff, right? But it's number one, it's not even pre-qualification is a bunch of crap. Honestly, I could ask you what you make and do you have a pulse and say, sure, you're pre-approved for that place or pre-qualified for that place.
I think I make this.
Yes.
And I'd like to buy a house that's this expensive.
And my credit score is 3 digits.
Totally.
Right? Okay, cool. You're pre-qualified.
Winning.
Pre-approval. They knock out an application. They run credit, right? We see income, we see assets, but we don't, we as an industry don't necessarily verify that.
Okay.
Right? But we can take it and, we underwrite people and deliver a loan commitment letter that literally says you are approved for that purchase price, subject to an appraisal and a title. Sure. And getting title, right? That's right up there with a cash offer because we're done. We verified, we've done all the work.
Well, and that's, I think, important to note, right? If we rewind, we've been doing that now for probably 2 or 3 years. If we rewind before then, you couldn't get a loan fully underwritten without the property.
Right.
You needed the subject to be able to do so. Now we can do so in advance so that once again, when we're going in and telling, yes, we have a mortgage contingency, we're going to do this. Or we have some clients that are saying, hey, I'm a little riskier. Let's write it as a cash offer subject to financing so that I can compete with some of the other cash offers.
Yeah, 100%. And that's one of those are the conversations that we have. Well, number one, you always copy me on the offer being 100%. Submitted. And if that's not being done, you're missing. That introduces everybody right away, which is huge. It allows me at 10 o'clock or whenever you'd like to submit your offers, in the morning and at 12 a.m., 1 a.m., you'll submit offers.
I don't
sometimes.
Expect a response till at least 6 or 7 a.m.
Correct. And at 6 or 7 a.m., I can respond to that email and not wake someone up with a phone call.
Yes.
But me reaching out to the listing side is huge.
Confidence.
Right? We do it right after the offer when it's submitted at a waking hour when it's people are still up. We'll often call.
I get that I don't sleep. Everybody knows this. Anybody that's watched this podcast knows I do not sleep.
We'll call the listing agent and say, hey, you just received an offer from Amanda. It's got a letter from me in there. I'm a person.
Right.
I'm a voice.
Not an online lender.
Not an online lender. I have a phone number that reaches me. Right. So it's that personal touch that helps really push it up to the top.
Well, I think one of the things that a lot of buyers don't quite understand is that in these competitive situations, the agent you work with is very important. The team you work with is very important. Now, I'm going to tell you a little secret that Dan doesn't always like to hear. I think he knows, but I have some clients that say, no, I want to come in and use this lender. And I say, for the sake of our team, for the sake of being competitive, I need you to talk to Dan, get pre-approved by Dan, just so I can sell the snot out of your offer to this person. And then if you want to talk to him and talk to your person and talk to everyone else, but I need the ability to go to a listing agent and say, I got my A team here. We are going to hit the closing line without issues. That's a big deal.
Yeah.
Same is true as on my listing when all of a sudden I'm looking and I'm saying, oh, there's that Rocket Mortgage. Or, oh, that listing agent I've had, or that buyer's agent I've had some issues with in the past. They canceled 3 deals on me at one point in time. Whatever that is, that team matters. And it's not just the agent.
It matters more than ever, especially in a highly competitive environment, right? If you get multiple offers, you could have 3 offers at the same price. Online lender on 1, big bank on 2, someone like me on 3. If the agent on 3 is someone they know and the other, you know what I mean? It's just,
Totally.
it's all, I graduated college with this concept of it's all who you know, which, I had a great time. Had a great time. Things have worked out for me.
It was that like co-ed naked soccer thing, right?
Yeah, totally. But yeah, it's like that kind of thing. It really is. Chicago's the smallest big city on the planet.
We just had it this past week where we were in a competitive situation, even in the second half of the year, where it was ultra competitive and our team, our clients won, and they were not the highest offer. And they were not, we beat a cash offer.
Yeah.
So we beat a cash offer that was netting the seller more. And that was because the agent said, you guys will get us to the finish line.
Yeah. And then that's not bullshit either. Like, don't even pardon my language. That's the real term. Like, it's not bullshit.
Right.
That works. And it's, that's how people win.
I think the other strategy that we've used a little bit in the last couple of years in the competitive situations is that we have some buyers that want to do smaller down payments, but they have the availability to do bigger ones. So a bigger down payment in a competitive situation looks more favorable, right? If you have 20% to put down versus 10%, the 20% is going to be more favorable. It's a limited review. It's an easier loan. So sometimes what we'll tell our clients is to say, realistically, those contingencies are just what you have to do if we have complications.
Yep.
So we have clients that sometimes we say, okay, let's say worst case scenario, we'll do that. But then we do the financing that we prefer to do. So we made ourselves more favorable from the seller's perception.
Yep.
And then we did what we wanted anyways, because the contingency was just to essentially protect us if we got into trouble.
Exactly.
Now you can't use that strategy if you're not willing to do the larger down payment.
The conversations have to be had in the correct way.
Yes, exactly.
Right? But no seller on the planet that I know of has ever showed up at a closing table
and said,
and went, they're borrowing more money than they agreed to.
Right? Never.
Right?
Ever.
I'm getting the same amount, but they borrowed more.
Shame
right?
on them.
Yes.
Shame on them. Here's another kind of interesting concept on that is, are you seeing any differences? Because I can tell you, I ask a question that most lenders will answer, even though I don't know whether or not it's appropriate. When I call lenders on my listings on behalf of my sellers, and there are 2 people on it, I always ask, if one of them loses their job, can the other one carry and still get qualified?
You're the
or
only person that has ever asked that question. I swear to God, I've never gotten that question from one listing agent ever.
I don't know if it's an appropriate question. But in my philosophy, if I can go back to my clients, and not to say there's anything wrong with being a single versus a couple, but if I'm looking for the deal that has the most likelihood to hit a finish line in a day and age where job security can be a little goofy, that is something. If we are really truly splitting hairs on an offer, that's something that I ask.
No, it's a great question. And it's almost, I'm going to almost use it in my conversations with the agents now, saying, hey, I know
we're all getting better, people.
Right? You got to learn something.
Right?
Right? I learned
I don't know if
today.
it's quite ethical, so you might want to cross-reference that first.
Well, yeah, I can just say if one person dies and the other one, or one person loses a job.
Now we're killing people on this podcast. Right? Don't worry, your spouse just passed away, but you could buy the house.
Yes. If I said how much life insurance I'd have, that would be bad. Right? Like that would be disclosing too much.
Probably.
Right.
Let's agree on that.
Yes.
We're like crossing humanity lines now. Hey, you want to talk about the president again?
No.
I think the piece I want to kind of end this question on, has to do with the fact of just what I consider the power of G rate. I'm not quite going with that whole rate thing yet.
I'm not used to it either.
I'm still G rate. Just I think that it's one of those things that it's such a recognizable lender, especially in the Chicagoland area, that whether it's me putting an offer in or me assessing competitive situations, the minute I see the company name, I understand the processes. I know the network. I know the way the teams work. I know from that. Now, I also know that I've got the best G-rate lender, but I also know that sometimes you can help me navigate some of those situations as well. But I think it's important to note that it's a brand that's recognizable. And that's very important when we get into these competitive situations, even if the agent doesn't necessarily know you.
Yeah.
That breeds confidence. And this whole market is about breeding confidence to get to the finish line.
Yeah, I mean, we've been the number one lender in Chicago for, it's like 10 years in a row or something. Yeah. Right? So if their agents don't know who we are, then that agent doesn't do any business. Right? But no, you could think of it from, like, I'm sure when you're flipping through an offer, right, and you get to the pre-approval page and you see the logo, you can almost like shut it and be like, okay, cool.
I feel confident.
It has G-rate on it, right?
Sure,
or rate
100%.
or guaranteed rate or whatever we're called. It still doesn't flow.
A, B, C,
it still doesn't flow when I
above.
say rate, it still doesn't flow. But yes, it's the same way as a listing agent when they see ad properties.
Sure.
Right? It's the two biggest companies in Chicago teaming together. And, yes, not everyone here is awesome at what they do, right? Not everyone at ad properties is awesome at what they do. But together and just leveraging the names wins. Just flat out.
It's just branding.
Yep.
Okay, so let's get down to the nitty gritty. What are some of the lesser known financing options that we're seeing in today's day and age?
Yeah, there's so many options that, 12, 24 months ago just didn't exist for people. So it's opening up a lot more options for people, not even first-time buyers, just people in general, right? Okay. We're seeing, we have loans that, and mind you, these aren't 2008 crashing the housing market options. These
we're going
right?
deep now.
These are real options for people that they make sense for the right situations.
Okay.
Right? So
are we talking like stated income stuff?
No, they're verifiable income sources.
Okay.
Kind of thing. So someone who's self-employed has the opportunity to write off a lot of their expenses.
Sure.
Right? That aren't write-offable for other people that are salaried, right? So if you're self-employed, you can write a car off. I drive a ton. I can't write off anything, right? So I have a disadvantage than someone who's self-employed in the same numbers, right? So it's people like that. We can average deposits in their bank statements. Like for 12 or 24 months, we literally add up all the deposits, subtract out the expenses we can see that are repeatable, and divide that number.
So we're actually verifying it now versus the 2007, 2008
just saying, what do you make?
Of stated income where we said, I make X.
Yes.
And it just went.
Correct. Okay. Yeah. These are real, like we actually document things.
For certain.
Loans,
and so is that, obviously there's a lot of qualifications for it, but for self-employed people, that has always been a tough sector to get financed.
Now you're getting a rate that's a little bit worse than a traditional loan, but you're getting a mortgage that you couldn't get before.
For certain.
Right?
So here's a question for you. I'm going to go down this rabbit hole with you a little bit. I'm self-employed. I use one of those products. I'm in that product for a couple of years. Rates get more compelling. I want to refinance. Are you still looking at a program like that? Or are you, now that you've gotten a little bit more
No, we do the whole
traction,
thing over again.
We
do the whole picture again.
Okay.
Right?
Perfect.
And take a look at it.
For certain. See what makes most sense.
We're always going to find the best options for people.
Okay.
Right?
Perfect.
Or we're going to explore how to get them the best
So
option.
if your situation has changed or the program has changed, then you're looking at something different.
On the flip side of that, you could have someone who started their own company that's not what it used to be, right? So then we have to verify it again.
Okay.
Another example, someone who, let's say someone in their 50s has enough money to retire.
Why's it got to be about age?
If they're in their 30s and they're in this situation, there you go. I'm talking
rock on.
I'm going to my age.
I'm still 30.
Yeah, exactly.
Like the episode.
A couple of times in a row.
Just a few.
But for someone who's retires before retirement age.
Yes.
have a lot of
30.
money. They might not have set up income streams yet,
Of course.
right? They don't have anything, but they have a ton of assets. Those loans are doable now.
Sure.
We can take their assets with some calculations and divide them by 84 months. And that's what we give them on for their income, right? So people who, yes, they can pay cash. They don't want to pay cash. Now they can get a loan and depending on down payment, they might get the same rate as somebody that's in a normal loan, right?
And I'm going to botch all of the characteristics of it, but I feel like we've done a few in the last couple of years where we've had maybe retired people that are using different income streams.
I know
where
exactly
you've had
where you're going.
You know where I'm going with this, right?
100%. It's someone who has a bunch of, they're of retirement age. And mind you, IRS retirement
30.
age. Yes. Plus 32 and a half. So people that of our retirement age, they can set up, they have the intent to set up, IRA distributions for their income moving forward. They haven't done it yet. We can set that up for them into perpetuity, and they receive it one time, and that's their income for the loan, right? So it's right there. It's real money. The same thing we can do for trust income. If people have a lot of trust income, they can set up trust distributions and finally start taking that money to allow them to buy a new house. So those things didn't exist before. And the financial world, I think, has come to realize, probably through statistics and actuaries out there, all the number nerds out there that have determined, guess what? Those loans perform just as well, if not better, than someone with marginal credit and very little down payment.
100%. 100%. The other thing that I've seen more, and I'd be curious your thoughts on this, is I feel like we have, where this isn't an unusual program, it feels a little unusual in the time. There was a period of time for probably 3 years where we did nothing but 30-year fixes. And I feel like the reemergence of the ARM products is very real.
Yeah, no, it's very real. And I think it has to do with the financial markets, right? And I think depending on where, the bond markets go, I think you might see ARMs get even more attractive because people are going to start, they might leave so ARMs are determined by the Treasury, typically like the 10-year Treasury, but more on the shorter end of that, like the 2-3 year Treasury yields. If people buy bonds, those yields go down. If more worldwide investors are purchasing the shorter end of the yield curve, so the 2, the 3, the 5-year Treasuries, those yields drop. ARM rates will drop with them, and fixed rates might not drop. Sure. So you might see ARMs get more and more attractive for people, but it's also those first-time buyers who we talked about it before, where they figured that I finally have to buy something, and it might not be their forever home, but they're comfortable saying, I'm going to leave in 5 years. I'm not going to live here in 5 years. We don't do a 5-year ARM. We do a 7-year ARM.
Thank you.
We give them a little bit of time. But it makes sense for those people.
And we never do 3-year ARMs.
Right, exactly. So we're going to go on the 7s and the 10s, right? The longer ARM programs, because again, you can refinance ARMs. There's no prepayment penalties with any mortgage, unless it's the investment side, and we're not even going to go there because those are so specialized. But you can't be penalized for refinancing.
No, and I think that's a great topic. And where we've seen them come up is obviously in our world of some higher interest rates, is that we've had clients that have said, okay, I'm cautious, I'm risk averse, I think I'm only going to be in this property for 5 years, but we all know that 5 years can turn into 7, can turn into 10. Those are people that maybe we say, hey, let's look at a 10-year ARM under the concept and understanding that the likelihood of either selling or refinancing within that 10 years is incredibly high.
Yes.
Right? We obviously understand the worst case scenario is you get to year 10 and the rate goes up.
Yep.
But the likelihood of getting there is so low that we feel confident that even for the most cautious of buyers that it makes sense to do a little bit of savings.
All you have to do is just explain it to them. Right. Like if they just were to listen and not listen to their parents saying only do a 30-year, only do a 30-year.
Even though parents are always right, especially of 8 and 10-year-old little girls.
Once they listen and they hear that, and they kind of, again, we have to take the misconceptions out of it, right? Yes. That there's no penalty for doing it. You can refinance. Yes. Those kinds of, and you're paying it on the same schedule as you do a normal 30-year fixed, right? Yes. And you actually build principal quicker with a lower interest rate. So at the end of the day, if they're there for all 7 years or whatever, you're going to have more equity with the ARM loan than you would the fixed because the rate was lower.
100%. Okay, so we've talked incessantly about how our first-time home buyer is a big group right now, right? There are a lot of people out there that want to buy homes for the first time. What are some of the questions that you're seeing come up a lot on your end?
Yeah, I think, well, first, it's odd. First time buyers used to be 3%, 5%, like minimal down payments.
Yeah.
Now people have been waiting so long and they're a first time buyer with 20, 30, 40% down payments. Totally not normal. You know, well, nothing is normal, but the traditional first time buyer, right? Just, you know, they've changed a little bit in that way.
Yeah.
But I think it seems like first time buyers don't consider ARM loans like they used to in the past.
Sure.
Because they're so focused on, their parents telling them they should do a 30-year fix, which they always have. But I think now those are more discussions that are open because you do save a little bit in the rate world with doing an ARM versus a fixed. You're getting a lot of first-time buyers that are just, they seem to have great credit too. They've really focused on that. So that's more of a, what can my credit score get me now? Right. Yeah. So I think there's nothing that's necessarily out of the ordinary. Actually, let me take a step back. Something that doesn't exist anymore that did prior to the new administration. I say new, they're old administration at this point. It seemed like it's been forever.
Are we talking about Chicago administration or
no?
The
I'm talking about
States?
United States. But they took away all they took away all the first time buyer grants and things like that we used to use to help people. They could use it to buy their rate lower, right? They could use it to offset closing costs. They'd get special rates in certain areas. Those programs are just gone because they decided to turn them off.
Okay, if we're going to go down this dark, ugly road of the administration and how it's going to impact this stuff, first-time buyers or possibly others, what are you seeing? Let's rip the Band-Aid off. Let's talk about some of this. We have a lot of clients that are either here on visas or not U.S. citizens. Like, what are you seeing in terms of that, other than a tremendous amount of fear?
Yeah, I mean, that stuff hasn't necessarily changed yet.
Okay.
And I think it's just, I think yet is for sure the word. Like, just from you could go down the dark hole and think that, oh my God, people aren't going to be able to get those loans anymore. And
is that the coffee enema hole?
Right, exactly. That was bad. But anyways, we're going to roll with it. But yeah, those kinds of things people can still get mortgages on them. Mm-hmm. But I think you're going to see more private lenders be willing to do that. Yeah. Right. Like, so that in the agency world, like the Fannie, Freddie, FHA world, those could be turned off. But again, it's one of those, like, are they going to cut off their nose to spite their face kind of thing? Because there's this huge subset of people. But I think where you're going to miss out on those, it's the people with visas, I think, are still going to do things. It's the people on the lower end of that scale, like what they used to be called, they still are, like I-10 loans. Okay. The people that are the more manual labor side of the things. Yep. Right. And for the lack of a better way to put it, like the minorities that are simply afraid. Sure. Right. That you're removing a whole section of people that were 100% amazing buyers, amazing homeowners, values to everything in their communities and all of our communities. Those people are not going to be doing stuff. Sure.
No, absolutely. And not to get too much off track, but obviously those are things that we're navigating. We're in the trenches trying to work through and see kind of what we're going to deal with next. From my side, I think the big question marks with regards to the first time buyers are just, there's so much fear out there in terms of the process, right? There's so much fear of, everyone has a friend that's written 10 offers and not gotten it or done something from that. And so, I know you and I work so similarly and working with the same people often. It's about the education. It's about the, for example, we had a client last year that was, I think they wrote 3 offers and they were just, you could tell they were tapping out of steam, right? You could tell that they were just losing momentum. And that was somebody that we said, hey, extend the lease. Let's look at the end of the year. I remember we put them in under contract, I think the first week of December. They closed the first week of January, and then they watched the market take off the next spring, and they couldn't have been happier. But like understanding, I think that there is a tremendous amount of concern in our first time buyers, people that are just trying to get it and trying to understand what's happening in our market. I think always understanding affordability is a big thing for them. what can I buy? How much can I afford from that perspective? I think that's something that, we are always trying to be so in tune with. And I think the hardest thing, as we've said, is talking about where the rates are. You and I do this all the time, understanding that you're buying at a number that we think is more of the stretch, under the hope and the idea that in the next couple of years, we have the opportunity to refinance and own a property for less money. Like, that's a concept that is very foreign to somebody that hasn't owned property before.
Yeah.
From that perspective.
Yeah. And I think another part of the whole nervousness of the first time buyers and the lack of education is that people do a lot of stuff online, and they're looking up stuff online, and yeah, it's great. You can find out a lot of information. It's always like, I always tell my wife, please don't Google what you're feeling sickness wise, because it's going to be horrible.
I love WebMD.
Yes. It's a disaster.
You want to hear what I've self-diagnosed?
Yeah, I know. Seriously. Right. But I think that's part of it too. And that's where involving us in it. And
totally.
I always tell people, listen, the way our process works is after we set the loan up, it goes to the team to handle it. Ask me every and any question you have, and ask my team.
Right.
Everybody's going to answer your questions. We're never going to tell you that there's too many questions, right? And we've been doing it a long time. If they ask us a question we haven't heard from before, that's a great day. Like, we just learned something that that someone has a concern about, or some, bit of misinformation that's out there that we can use in future discussions. But it's always ask.
Yeah.
Because, and if you're asking and people aren't answering you, that's a major issue.
So I would say that the one last question that I want to kind of end on, because I think it's in both of our sectors, a huge question that we get from the first time buyers comes down to, should I rent or should I buy? Like, this is one that is always repetitive, and I think the important things is that there is a financial aspect to that. And then there's a lifestyle and a convenience aspect to that, right? Buying a property, I don't necessarily say it's like the marriage, right? You can divorce the property, but it's something that it takes a little bit of a longer commitment, right? I have never been one, regardless of what the market was saying, hey, live in this for 2 years and then we can sell it.
Right.
Live it in for 2 years if you're open to holding on to it in case the market doesn't support that, and maybe you hold on to it as a rental property or something like that. But like, the short-term thing is a big thing for me. If somebody's looking to rent, I always lean back on, does their life need the convenience to be able to pack up and go? Turn the keys in and walk away.
Right.
Like, that's a big thing. Do you find that you're getting that question a lot in terms of people coming to you and saying, because you look at the financials more, like, here's what you're doing with your rental. And as a landlord, I love this part of the rental. But do you feel like you're getting that question a lot too?
Yeah. And yes, we are getting those questions. And it's also, it's funny because one of the first questions when we talk to people, that what can I buy and why do you want to buy? But they're like, yeah, I want to spend X. I'm like, well, how did you get to that number? Right. And then I'm like, what do you pay in rent? And they tell me their rent and they say, well, what can I buy for that? And I was like, nothing. Right? Like, it's those people come in saying, this is my rent. And
I want to match that number.
Yeah. And it's like, that's a great rent. Clearly you've either been there a while or you have a great deal.
Yeah.
That's not just how the mortgage side and owning a property is, works anymore. I'm like, but you're going to get deductions. So yeah, your net payment might go up at the end of the year. It's effectively the same.
You have an equity portion of your payment.
Yeah, exactly. And the tax deduction portion of your payment. So,
and appreciation.
Yes. So it's people are worried about that future payment, but once you break it down for them and explain it to them, I think they get more comfortable pretty quickly with it. But that's one of the things is like, well, what can I, what does my rent payment get me? And it's like,
not an equivalent.
Yes.
Okay. We are all about the education. Let's spend a couple of minutes. I just want to dive into some of the biggest mistakes that buyers tend to make. Don't worry, sellers, we're going to get to you too, but I'd like to talk some of the things that we see that we can help our viewers kind of navigate through without doing. So some of the biggest mistakes that I see right off the bat, first and foremost, not assembling the team. Not getting the right people in your corner, not figuring out what your purchasing power is, not aligning with an agent. Like, right off the bat, I've always said step number one is assemble your team and do so well. Otherwise, you're kind of rogue, right?
Yes.
You're going around, you're like a loaded weapon without any lesson on how to take care of it.
Yeah. I think you talk about not working with an agent. And yes, the commission thing that came out, right, where buyers were supposed to be paying agents, and yes, that would increase your cost to purchase, but it's back to what
nothing has changed a year later.
Correct. It's
People
all back
are
to
still working with agents.
sellers.
The
are still
discussion
paying,
is different.
Sellers are still paying commission. You got to word it a little different, right? It's still the same.
We're not supposed to say it that way.
I don't know how to say it. I'm not a real estate agent. I say it the way I say it.
Right. Totally.
But those kinds of things, like people think that I can buy a house without a real estate agent. You're insane if you think you can buy without a real estate agent. In the same way, you're insane if you think you can purchase a home in Chicago without a real estate attorney.
Right.
Just because someone has the JD or whatever their designation is after their name, if they're not a real estate attorney, they're not a real estate attorney. Simple as that.
Right.
We've had transactions
with
together,
Uncle Vinny,
apart.
the divorce lawyer that's going to navigate the world for
They
us.
don't know how tax prorations work. They don't know how, they don't know how to read condo docs, like those kinds of things. That's a huge mistake.
They cost more than
the
attorney
not
fees.
paying $700 for a real estate attorney
Right.
will cost you more than $700 in either a missed tax proration. They didn't calculate it right. You're going to spend a lot more.
100%.
Right? Same way, if you don't have if you think you can purchase a home and write an offer with Uncle Joe, who's the real estate attorney, to help you put an offer together, or not the real estate attorney, Uncle Joe, who's the whatever attorney, you can't do that. You need someone that's on your team that is looking out for you. Like, how do you buy a house without a buyer's agent when an inspection happens? Like, where do you get the inspector from? Where do you, when things go wrong in the inspection?
Can I say the yellow pages?
Yes, but who the hell else? Do those exist?
I don't know.
Yeah.
No, we do have some. We do paper mache with the kids.
Oh, there you go.
So we still use those for them.
Perfect. But like, you know what I mean? Like if an issue comes up in inspection.
What's an issue? What's not?
Right.
How do you navigate it?
Exactly. Those kinds of things you can't do that. You
can't. Let's be clear. You 1000% can.
Yes.
But you are probably opening yourself up to a tremendous amount of exposure that can go poorly and cost a tremendous amount of money. Now, once again, I'm going to get in trouble for saying this. I'm going to preface this. There are probably quite a few agents that aligning with them is going to have the same result. So maybe some people are better by themselves than with certain agents or something like that. But it's one of those things that as a consummate professional that takes my work incredibly seriously, that I want to see my clients succeed in this market, I think the value that is brought from agents is a drop in a bucket in the big picture of home buying.
100%.
Some of the other things that I see, right? One of the things that I am once again adamant about, we all know I like my soapboxes, I like to stand on them, and I like to shout from the rafters. Spending too much, being house poor, not worth it, ever. Ever, ever, ever. People come to me and they say, Amanda, you sell the American dream. No, I don't. I sell the backdrop for the American dream, right? I sell the stage for it. You create a home, you create a life, you create everything. It's just the backdrop. So you know what? Overspending, getting to the point where you buy this place that's so amazing that checks all your boxes, but you can't afford to live in it. You can't afford to furnish it. You can't afford to have your friends and family over to enjoy it, is not worth it. Real estate is a ladder. Acquire what is within your comfort range. You want to stretch a little, but don't stretch too far that impedes your life. Overspending is a huge, huge issue for me.
Yeah. And I mean, I see that too, right? On my side.
What if I just spend a little bit
Yes,
more?
Exactly. Are you truly comfortable with this payment?
Right.
Well, I can push it. No, but then you're not comfortable with it.
Yeah.
Simple as that.
I think the other thing that I see a lot, and this is one of the hardest things about buying real estate, in my opinion, is thinking it's very easy for us to know what we need today. But we have to have a crystal ball in this. Because realistically, I already said real estate isn't a short-term decision. You don't buy for 1 year. You buy for 3, 5, 7, 10. And so you need a crystal ball in saying, well, what am I going to need 3 years from now? What am I going to need 5 years from now? And what am I going to need 7 years from now? And so for me, like not being aware of that. No, you're not going to know those things, but you absolutely want a property that has flexibility. In flexibility, that's the word that I say is the most the best characteristic a property can have. Flexibility in how you live in it, flexibility in how you use it, flexibility of how you change with it, whether that's you can morph into the space differently, you can renovate differently, or if you can't do that, you have the ability to move on and keep it as an investment. Real estate only loses money if you have to sell it. That's the only time real estate will ever lose money, is if you have to sell it, and you have to sell it at an adverse time. I tell this story all the time. We've been in our house now, hold on, I got to do the math and I probably need multiple hands. We've been in our house for 19 years, right? We bought it in 2006. So yes, my math is correct, 19 years. We bought it in 2006. Fast forward to 2009, 2010, housing crisis, fireworks, terrible, terrible, terrible. My husband came to me on a regular basis and said, what is our house worth? And I said, it doesn't matter. I'm not going to tell you. And he'd say, what is our house worth? And I'd say, you know a lot of real estate agents. Go ask one of them. He would ask me time and time again what our house was worth. It didn't matter. Our house was probably worth at that time about 25% less than what we paid for it. But we weren't going to sell it.
Right.
So it didn't matter. It didn't matter that the value was down. We weren't selling it. It didn't matter at all. It didn't impact us. Fast forward to now. Our house is up 300% from what we bought it. So does the 25% down matter? Only if we had to sell in that market.
Yep.
So if you have a house that's flexible, that either you can grow or change in, or you can hold on to, grow a portfolio and do something else with, that gives you the ability to not lose money in real estate.